What are the best and worst investments that you can make? Well, in this video, I'm going to be ranking the top 15 most popular investments on a tier list from S for super to F for fail. And at the end, I'll rank one of the investments as the best of the best, raising it up to S tier plus, and one as the worst of the worst, demoting it to F tier hell. And to make sure that your favorite investment doesn't end up in F tier hell, it's going to need to tick 3 boxes. 1, it needs to offer strong returns relative to risk. So if it doesn't offer a good risk to reward profile, it's going down in F tier. 2, it needs to be accessible and realistic for most people. That means you don't need millions to get started, and it shouldn't come with a ton of hidden barriers that make it impractical. And number 3, it must have a clear, straightforward path to growth over time. If it's confusing, unpredictable, or overly reliant on luck, it's getting knocked down. So let's get the worst one out of the way with trading options. Options trading lets you control stock position without ever actually owning the stock. And while it has really good potential for returns, it's also pretty risky. Options are used for a ton of reasons, and they can be used to hedge your portfolio or just completely speculate all your money away. And because of that, most new option traders tend to lose money because they are very complex and they're time sensitive. And according to a paper from MIT and Stanford, option traders make a quote trio of wealth depleting mistakes. They bid up prices around earnings time, they incurred enormous bid-ask spreads, and they didn't close trades as quickly as they should have. And I mentioned those 3 points to show you that the learning curve is steep, the risk is really high, and most people should not really even start with options unless you really know what you're doing. And even then, it's not guaranteed to make money. So there's really no clear long-term compounding strategy for trading options. So because they failed the clarity test and the accessibility test very hard, this one's going down in F tier. Let's move on to dividend stocks, which are companies that pay you a portion of their profits, usually quarterly. People love them because of the passive income and the lower volatility that you typically see with these companies. And a study from Hartford Fund shows that dividend growers have outperformed the broader market historically while also being a lot less volatile. Now, these are accessible via ETFs and individual stocks, and they have a clear path to wealth through reinvestment so long as the underlying companies continue to make money. So why is it not in S tier? Well, first, it's not always as diversified as you might like, and growth can sometimes lag behind these smaller, faster growth companies. It's also important to know that dividends aren't the only way that companies can give back money to their shareholders. Another way to do that is called stock buybacks, and these have been increasingly popular over the past 40 years. They pretty much provide these same type of returns without having to pay shareholders directly. The reason I bring this up is because YouTube Finance tends to worship dividends as the greatest form of investment, but really there's nothing special going on here. And if you own dividend stocks in a taxable brokerage account, every time you get paid a dividend, you have to pay taxes on that. So for all of those reasons, I'm putting dividend stocks in A tier. Next, we'll move on to a little bit more of a controversial one, which is Bitcoin. Now, Bitcoin can be a little bit polarizing. Some people see it as the future of finance, while others call it the tulip mania again from 1634. Now, that being said, Bitcoin as an investment is very volatile, it's speculative, and it's still evolving. In fact, Fidelity Digital Assets says that it shares some traits with gold in terms of store of value, but the price swings are obviously way more extreme than gold. Every few years, it goes through dramatic cycles, dropping from minus 40% to minus 99% at one point. But I will say that volatility alone is not a good reason to call a single investment risky or not risky. And with platforms like Coinbase, for example, they're pretty easy to access in terms of most people being able to buy it. It's also had one of the greatest returns, if not the greatest return in all investment history, with something like a 2 billion% return. And honestly, that's kind of hard to fathom, and that's how it performed in the past. Now, that doesn't mean it's going to happen in the future, and technically it can't. And that's because if it were to gain another 2 billion%, it would be up to $36 quintillion, which to me sounds like a fake number. So because Bitcoin has insane price swings, it fails the long-term clarity test. It's still very confusing for people, and it doesn't have a widespread adoption like other currencies. It's going down in D tier. Sorry. Next, we'll move on to the S&P 500 index fund. Now, if there was ever a cheat code for investing, this is pretty much it. The S&P 500 has returned around 10% annually for the past 90 plus years. And according to a 2015 Vanguard study, 80% of active managers still cannot beat the S&P 500. And if you don't know, an active fund is one that has a manager who's trying to beat whatever benchmark they're put up against. Typically, it's the S&P 500 if you're in the equity markets. And the fact that 4 out of 5 active managers cannot beat the S&P 500, which has a long-term return of 10% before inflation, 7% after inflation, that should tell you how difficult it is to outperform the S&P 500 because these people eat, sleep, and breathe financial markets, and they still don't beat it. And active funds usually have a lot higher fees than something like a typical index fund. So it's worth asking the question, why pay more for less? And possibly a more important question is, why spend your time trying to beat the market when you can get really great returns historically with the S&P 500? It's low fee, it's super diversified for the most part, and you can get started with as little as $1 with pretty much any brokerage. That checks all 3 boxes: great returns, very accessible, and a relatively clear compounding path according to historical performance. The S&P 500 index fund is going in S tier. Moving on to US Treasury bonds. Now, let's be honest, these things are boring, but boring can be good with your investments. US Treasuries are backed by the full faith of the US government and historically have provided some stability during downturns. That's felt a little bit different this year with everything going on with Trump and the tariffs, but nonetheless, the US dollar is still the global reserve currency and the US economy is still the biggest in terms of GDP. And while that might always be the case, we'll cross that bridge when we get there. And according to the CFA Institute, US Treasuries have served as a hedge during bear markets, but the long-term returns are around 1 to 3% after inflation. So are they accessible? Yes. Are they safe? For the most part, but because they have very low growth, I'm putting them in C tier. Let's move on to something similar, which is corporate bonds. Now, these pay a little bit more than treasuries, but they come with some added risk, and that's because you're lending to businesses and not Uncle Sam. In exchange for that risk, you're getting higher yields, which means more money if they pay, especially with investment grade or high grade options. And with corporate bonds, you're lending to a company like Nvidia, for example, in exchange for some regular interest payments, usually twice a year. But unlike stocks, you don't get any upside if the company does really well, you just get your fixed payments. So returns can get capped with corporate bonds, and it's good to make sure that the underlying company doesn't go bankrupt, of course. So they're good for income, they're relatively accessible via ETFs, but they have limited long-term upside and you have some credit risk and some individual company risk. Corporate bonds are going in B tier. REIT stands for Real Estate Investment Trusts, and these let you invest in real estate without all of the headache that comes with owning a physical property. And they're legally required to pay out 90% of their income as dividends, so they're pretty reliable in terms of getting income. NA REIT data shows that REITs have historically delivered competitive total returns similar to stocks, but with some added diversification. They're also historically less volatile than the total stock market. So for example, if the stock market were to drop 10%, REITs might only be down 5%, which can help ease some investors when things are feeling a bit chaotic in markets. By the way, this is not financial advice, I'm just sharing my opinion here, but one of the reasons I'm considering adding REITs to my personal portfolio is because when you invest in real estate, typically it requires a lot of leverage, especially if you want to own multiple properties in a short period of time. And because I'm not a huge fan of using leverage to build wealth, REITs might be a good option to add to my portfolio without having to take out some massive loans. So they're easy to buy through brokerage, they have solid income, you get real asset exposure, and you get some overall diversification. Because of that, I'm putting REITs in A tier. Speaking of real estate, rental properties are next, and this one is not for the faint of heart. That's because you can build some serious wealth through rental income and property appreciation, but it's not passive by any means. You'll need a lot of capital, like we just talked about. You're gonna need time, you need management skills, and you need to find reputable tenants that you can trust, and you need to run the entire investment like a business owner. For some people, this goes straight to S tier. For other people, it's a complete money dump. But because of the high barrier to entry in terms of needing a lot of money to start and the management load, I'm placing it in high B tier. Moving on to gold. Now, gold is not an income producing asset. If you buy a bar of gold and put it in that tiny safe that you're hiding in your closet, it just sits there. It's not a business growing its revenue, it's not paying you dividends, and it's not giving you rental income from properties. At its core, gold is a piece of nice looking metal. But the cool thing is it typically holds its value during a crisis. And historically, the return on gold isn't that bad. In fact, depending on the time frame that you're looking at, gold has outperformed the S&P 500 during certain times. The World Gold Council also shows that gold has a negative correlation with stocks during market stress, and that actually makes it a pretty decent hedge if you're worried about losing money during a correction or a crash. We've even seen this in the year 2025. Stocks have had a pretty rough start to the year, and every day it seems like gold is hitting all-time highs. In fact, it just crossed 3,000 for the first time ever in March of this year, which is crazy to think about because for the past 5 years or so, it's kind of been puttering below 2,000. So while it's been a decent hedge for when stocks crash and historically has some good returns, it's not really a wealth builder and it's mainly used for defense. I'm putting gold in C tier. Following that is a high yield savings account. Now, I want to be very clear about this. This is not an investment. It's really more like a parking spot for your money. You're not going to build wealth with a 4% return that barely outpaces inflation of 3.2% for the long-term average. And all of that is before taxes as well. But that doesn't mean that high yield savings accounts don't have a place in your finances. They can be a really good option for most people to park some of their savings money and earn a little bit of interest compared to just having it in a regular savings account. I've personally found it incredibly useful to earn about 150 to 200 bucks a month by keeping my emergency fund in a high yield savings account. And they're very easy to set up and transfer your money to, so they pass the accessibility test. But where they fail is in the returns and growth benchmarks, and that's because they're directly tied to interest rates. So for example, if you had money in these from 2010 to 2020, you would have earned next to nothing in terms of interest. So as much as I love my high yield savings account, this one's going in D tier. We'll follow that up with the total stock market index fund. Now this gives you access to small, mid, and large cap companies, and you can consider it like the S&P 500's slightly broader cousin. Historically, Historically, it's given similar returns with some more volatility, but it's just as easy to access. And for most investors, this is kind of a set it and forget it vehicle. I don't know if you know this, but the Mag 7, the top 7 big tech companies in the US, have been carrying the stock market for the past roughly 15 years, but recently a group of European banks have actually outperformed them. There are plenty of reasons for this, but the fact that a group of unsuspected companies outperformed the biggest 7 companies in the US just goes to show you that continuing to chase the big winners won't always give you the best returns. In fact, it's usually the opposite. So if you own a total stock market index fund like VTI, for example, that buys all the companies in America, or even a global fund like VT, which buys almost every public company in the world, there's a lower chance of missing out on these winners like the European banks, for example. So because a total stock market fund does almost everything the S&P 500 does with just a little bit more exposure, I'm placing it in high A tier. Similar to that are international index funds. Now these give you exposure to non-US markets like Europe, Asia, and emerging economies, basically everything outside of the US. Historically, international funds have underperformed US stocks, but that's not always the case. Japan dominated global markets in the 80s, European banks recently outperformed the Mag 7, like I just mentioned, and emerging markets can explode during certain times of global growth. The downside is you have currency risk, political risk, and sometimes slightly higher fees depending on the fund. But in terms of accessibility, you can get in through global ETFs like VXUS or VT like I mentioned. So because it adds some diversification outside of US stocks and it's relatively easy to access, these are going in B tier. Moving on to venture capital, thanks to AngelList, investors now have access to invest in early stage startups. And historically, this kind of access was limited to institutional or accredited investors only. Now, venture capital sounds cool, right? Maybe you invest in the next Airbnb or the next Uber, but the reality is most startups fail and you can lose all of your money. And even when one does succeed, it can take up to 7 to 10 years to actually get your money back. Now, the payoff could be huge, but the risk you're taking is massive and there's tons of illiquidity. So while venture capital is interesting, it's pretty much impractical for most. It's going in D tier. Commodities like gas, oil, and agriculture can be invested through ETFs, and these assets tend to move based on things like inflation, geopolitical instability, or supply chain disruptions. They don't produce any income, and they're generally more volatile than stocks or bonds. That said, they can serve as a good inflation hedge and add some diversification to your portfolio. Now, because they're accessible via ETFs and they can play a role in some advanced portfolios, commodities are going in C tier. TIP stands for Treasury Inflation Protected Securities, and these are US Treasury bonds that adjust with inflation, meaning your principal increases as inflation rises. These are relatively low risk, and they provide real returns, making it one of the few assets that directly fights inflation. But the returns are modest at best, and the taxes can be a little bit annoying with inflation adjustments if you don't buy these in a tax advantage account, like a Roth IRA, for example. Still, they serve a pretty unique role as a defensive tool in high inflation environments. These are going in C tier. So the moment you've been waiting for, what is the S tier plus investment? I'm sure you've guessed it already. It's the S&P 500. It's low cost, it's historically dominant, it's incredibly accessible, and it's very compound friendly. Like I said at the beginning, it's pretty much as close to a perfect investment as you can get. So what about F tier hell? Well, if you haven't guessed it already, this one is options trading. I've personally tried it for a few years now, and I haven't been nearly as successful as people claim to be on the internet. That's because it's incredibly complex, there's intrinsic leverage, and the timing makes it unbelievably difficult. And again, most beginners lose money on these, as we saw in the research earlier. So that's my tier list for the 15 most popular investment asset classes. Let me know in the comments below what you would change in here, what you would even add. Check out this video next to see how I saved my first $100,000, and I'll see you there. Peace.